What's up, opportunity cost investors? In this video, I'm going to break down how to calculate and communicate your actual performances so that way you can do portfolio updates, or you can just find out which portfolios you have that are doing better or worse than others. Now, in the past videos, I've alluded to some details on how to do this, but in this one, we're going to string together all of the details and add the essential ones you need to calculate your true performance. But before I do, I just want to give you an example of what a portfolio update would entail, so that way you have something to base it off of. And mind you, it is kind of mouthy. I left a guideline in the description below for you to check out. Alright, so here's my example of a portfolio update. Hey everyone, this is my year-to-date performance on my Vanguard brokerage stock picking account. Now before I get into it, I just want you to keep in mind that this is only one account that I have. I have multiple portfolios, so if you want to do a complete investment analysis on my strategy, you have to look at the entire picture. But let's dive into the stock picking account. On this stock picking account, I have a year-to-date money-weighted annualized return on investment of 20.11% pre-tax and 11.81% after tax. And for those of you that want to check out the transaction history, I left a Google Sheets document down below for you to check out. And following that update, I would go into details about any kind of miscellaneous information that needs to be included. For example, I told you an after-tax basis, but you would need to know I did conservative numbers on the after-tax basis, and then I included unrealized gains so that way I can under-promise and over-deliver. And like if you had a Webull account or a Robinhood account where you got free stocks and you didn't want to include those, you can provide the reasons why you included them or not. And then the audience can decide for themselves whether they want to adjust for that. Now eventually you're going to gain a rapport with your audience enough where you don't have to say money weighted annualized ROI. Instead you'll just say a return. But before you get to that point, you do need to address it. And as opportunity cost investors, I know we're including a benchmark as we do our portfolio update, which means I would also say the S&P 500 total return in that same period returned an annualized money weighted return on investment of 6.5%. And that's exactly how you communicate your performances. Now, I'm going to break down each individual segment and entail what each portion of what I said meant, because it might sound like Chinese to people, and that's okay. But I'm here to really simplify the process for you. But before we do, I need to ask you a question. What is rate of return? What does that mean to you? To different people, that means different things. And unfortunately, the apps that we have, the investment platforms, are no different. So let me bring you into a case study that I had with Webull. Probably like most people, I would expect rate of return to be if I put $100 into the account and it went up 17%, I'd have $117. It makes sense, right? However, that's not what happened with Webull. I put in $100 in a Webull account. I got 2 free stocks worth $17 or so. And I pulled all the funds out and I transferred it into Vanguard for the S&P 500 fund. Now, why is it that Webull showing me a negative 1.39% return on my money when it was actually closer to 16 or 17%? That yields an about 18% difference. So why is it that Webull is so far off? Well, it's because they calculated rate of return differently. They didn't include the $100 that I put in or the 2 free stocks. Instead, all they saw is what you had and what you took it out as, which is fine so long as we understand that, but that's not usually the case. And that's not really the number we'd like to see. We want to see the 17% that I put $100 in and turned into 117. And this runs into issues when we start communicating with people who don't have Webull and see rates of return that are different and don't understand that. For example, I've seen portfolio updates with people telling me that their Robinhood rate of return is 22% in 1 month. However, I don't have Robinhood, so how am I supposed to know what the rate of return is? And if you think this is just Webull, I'm here to tell you that no app is safe from me. I have the disclosure from Vanguard on what they define as a personal rate of return. A figure expresses a percentage that reflects your personal investment performance based on the investment choices you've made, how much money you've invested, not including reinvested dividends and capital gains. Why would you have a rate of return that doesn't account for those? That did happen. You put in 100, you had dividends and capital gains, and where are your actual gains, right? And Vanguard's not the only one. Let me read to you Fidelity. Fidelity is very similar to M1 Finance. Fidelity uses a personal rate of return calculated by the money weighted formula. And that's a good step in the right direction. But again, as I continue, you're going to find out that's not everything you need to know. Especially because just further down the line it says, the personal rate of return is an estimate only and should not be used solely in making investment decisions. So they know it's not accurate, but it is close. Even further down this line, it says that there are some accounts such as their 401k plans, the brokerage link accounts, brokerage flex accounts, certain insurance and annuity holdings and stock plans that actually use a time-weighted return instead of a money-weighted return. So even still, you could be using the same app, but have different accounts using different rates of return. And that just kind of gargles up all the analysis that we're trying to do. And the crazy part of all of this is if you had two apps with the same type of rate of return, so Fidelity and M1 Finance that use a money-weighted rate of return, you still can't use those rates of returns as synonymous comparisons. And the reason is, what if you had a Fidelity whose investment philosophy was to hold a security up to 364 days and then sold out, versus an M1 Finance that held it for 367 days and sold out? And for those who don't know, that implies completely different tax considerations between short-term and long-term gains. And that could yield, I wouldn't be surprised, 22% differences in their overall performances. And that is a distinction we have to make to our audiences, so that way we can give them an accurate depiction of what our overall strategy entails. In short, using the rates of returns on these apps not only are confusing, especially those people that don't have the same apps, but they're not accurate. And this is why I'm going to show you how to calculate and then communicate your rates of return. Now, without any further ado, I'm going to show you how to accurately calculate and communicate your performances by using my year-to-date performance. That way I can show you that the numbers we create can be plugged back into our transaction history and give you an accurate depiction of what your overall rate of return is. That way you can communicate it the right way. And if you've been following this channel long enough, you know exactly what that means. It's Excel time. Here we go, everyone. In this Excel sheet, I put down my Vanguard brokerage stock picking account. It's the only stock picking account I have. I know I showed you Webull before, but that was only an experiment I was running, which I'm going to make a video about later. I'm super excited for. First thing you're going to notice is that I have pre-tax figures in the top left corner. The reason why I have pre-tax figures, I do have after-tax, but you're going to want both. And the reason is you want pre-tax so that way if you're delivering your portfolio to your audience, they can apply your investment philosophy and strategies to their own situation, because everyone's tax situations are different. And then you want to show them after-tax figures because you want to prove that your strategy is tax efficient under your own scenario. Anyway, moving on. The first two things you're going to need are your beginning balance and your ending balance, which I have here and here. Notice that I'm just doing a year-to-date. Obviously, you want to do an analysis that's as far out as you can, but to keep things short, I'm just going to do year-to-date for now. Notice that I went from 14,300 to 3,700 without consideration of the withdrawals or contributions. One might believe that I had a terrible performance, and it would be likely too because COVID happened and dropped the market down. However, as you'll shortly see, I took out a lot of money, and I'll talk about why I did the things that I did later, because I believe that goes down to communicating performances, and I just want to focus on calculating them as of right now. So what you're going to want to do is make a column specifically for date, whatever period you chose. So I have January 1st all the way down to July 28th, which is my study period. Year to date as I made the sheet, not year to date as today, unfortunately. Next column, you're going to want to do cash flows. Now, cash flows, think of it like this. Your portfolio is going to be a box. If you put anything into the box or took anything out of the box, that's what's going to go inside this cash flow area. Now, it doesn't matter what happens inside the box. For pre-tax, after-tax, we'll need those considerations. But you just want to know what goes in and what came out, right? So notice that on the 2nd of January, I took out $2,500 about. You're going to want to follow that all the way down. I check my transaction history, which is different for every app that you use. So unfortunately, I can't go down and show you each one. It should be self-explanatory and there should be videos on it. But anyway, I'll show you at the very end. I followed it all the way through, and I did this delta, which is my net change. You don't have to do that. I just did it so I can check my numbers real quick. And the next column is the money weighted balance. And this is the crucial one. What you're going to do is you're going to take the beginning balance which is $14,295.71, multiply it by 1 plus this effective rate. Notice I have it set to 0%. I manually put in 0% right now. We're going to have Excel calculate it for us. This is very similar to a different video I did on exposing clear value tax. But the only difference now is we're going to, at the very end, add whatever's in that cash flow column. So we follow that formula all the way down, and we notice that if I had a 0% return year to date, then my ending balance would be $2,959.04. Considering the fact that my ending balance is now $3,676.97, that means I did better than 0%, which is good. So how do we get Excel to figure out this effective rate? Well, we're going to use the goal seek function. I'm going to do it the slow way first. So you go data, what if analysis, goal seek. What you're going to do now is you're going to say, I want the value of this ending balance equal to what it actually is. Just give me a second to scroll up here. To the value of the ending balance, which is 3676.97, by changing the effective rate. Okay, I'm gonna hit OK. Excel's gonna calculate it for me and find out that I had an annualized 20.11% return on investment pre-tax. This is pretty good. Now, I have another video where I demonstrate how to benchmark it against the S&P 500 total return, and I definitely recommend you check it out. I'll leave it in the description for y'all. But I did do the analysis on the side. Had I done the same thing with the S&P 500, I would have had a negative 6.26% annualized return. That means I grossly outperformed the S&P 500 year to date, mind you. Okay, and that is how you do pre-tax. We do have to do after tax. So we're dive into that sheet. All right, so in this spreadsheet, we have the after-tax basis. Now, notice that I have the pre-tax figures all to the left, so you notice the 20.11%, just like we just discovered. And on the right side, we have the after-tax, and then we have this table up here. In this table, I included all the short-term capital gains, the long-term capital gains, and the dividends that were both realized and unrealized. And the reason why I do that is because I want to make a conservative estimate of how much taxes I have accrued that are deferred till the time I have to do taxes, and essentially I have to pay them, because they do exist. Also, if I can prove that I can outperform even with this weight, and even saying that my benchmark is pre-tax, then according to the intrinsic way to measure opportunity cost, I've definitively proved I have outperformed my benchmark. So you're going to find this in the cost basis analysis. Each platform is going to be different, so unfortunately I can't tell you how to do it. You're going to have to find it out on your own. The hardest part about this entire analysis is knowing where you fit under the tax bracket. So that's something you're going to have to research on your own. For me, I put the amounts here, the tax rates here, and how much that would accrue, and the total amount. Now, to figure out our after-tax performance is quite simple. The hardest part is this table up here, and that's going to be different depending on who you are. So what I'm going to do now is this after-tax 3 columns that I have is exactly the same formulas as the previous analysis we just did. So now I'm going to do Alt-AWG to get the goal seek going. Once goal seek's up, I'm going to do the same process. So I'm going to set the ending balance of my after-tax analysis to, and you have to give me a second to fill it in real quick, to the value of. And this is where it's different. I'm going to take the ending balance, which was $3,676.97, and I'm going to subtract this tax amount, and I'm going to get an after-tax balance. So what this is saying is, if I had to pay taxes now, immediately, what would I have as an ending balance? And it would be $3,362.33. Now, this isn't entirely realistic because we have all this time to compound that amount that we owed for taxes. But the reason why we do that is because it's more conservative, because we want to underpromise and overdeliver. And then we're going to change this out as the effective rate, just like we did before. We hit OK, Excel is going to find out what that percentage rate is. And you can see after tax, I have a 11.81% annualized amount. So who would I be to you guys if I didn't prove without a shadow of a doubt that this is my actual rate of return? So what I'm going to do is I'm going to take my transaction history and use this rate that I say is my rate of return, and I should get the same ending balance that I have on my portfolio today. To do that, all I'm going to do is in a separate column, start with the beginning balance, which is $14,295.71, times 1 plus this rate, this daily rate that I say it is, add the cash flow. Okay, now I'm going to do it here, except I need to do this for the formula. Okay, plus the cash flow. Okay, and now I'm just going to drag it all the way down. And if this is truly our rate of return, at the very end, we should get $3,676.97. And there it is, $3,676.97. So that is our rate of return. Now we have to move on to how to communicate it. But can we stop there? No, unfortunately. And that's because I told you before, linguistics is an art. Meaning that just because I said that to you, does not necessarily mean that's my actual rate of return. We have to build that trust with each other. You have to know that I can calculate it exactly, and then I can do it continually for you to understand I know how to talk about my performance. Otherwise, what's to say I didn't miss something in my calculations? And this is why I love when people provide all their information for you and are as transparent as you can, and shows great merit, because you need to be able to calculate it on your own and make sure we get the same numbers. And this is why I dropped all my information, that Excel sheet we worked on, in the description below, because I want to be as transparent as I can, and I want you guys to be able to get the same numbers to hold me accountable. Additionally, on my website, jesserancourt.com/tools, linked in the description, you can download a money-weighted return template that you can use for your own calculations, in case doing it from scratch is too hard. But that's all I have for you on this video. Now, I do want to mention the fact that we only uncovered one of my portfolios. And I told you that you want to see everyone's portfolios before you make an analysis on someone's investment strategy. Because what if, with that $14,000 and how I brought it down to $3,000, I put it into something completely different and lost a ton of money? Overall, my asset allocation and my ability to choose portfolios and how much goes where is part of my investment strategy. And you need to know that, because it does bleed over. Absolutely. How to calculate your overall performance and the asset allocation, which I end up calling the individual rate of return, which encompasses all your portfolios, is going to be included in another video just to keep you on the edge of your seats. After that said, that's all I have for everyone today. I really appreciate you watching and taking your time out of your day to watch this video. I hope you like and subscribe and share with your friends, and hopefully we can get everyone's portfolio updates better than it was before. I'd really like to see what you guys do with this information, and if you guys end up doing a portfolio update using this, I'd really love to see it. Thank you all for watching. Until next time.